ETF dividends are payouts that you, as an investor, receive from the income earned by the exchange-traded fund, ETF, you've invested in. ETFs hold a basket of assets, such as stocks or bonds, and if those assets generate dividends or interest, the ETF can pass that income on to its shareholders. How do ETF dividends work? When the stocks or bonds held in an ETF pay dividends or interest, the ETF collects that income. Depending on the type of ETF, it can either distribute the dividends directly to you in cash, typically on a monthly, quarterly, or annual basis. Reinvest the dividends automatically to purchase more shares of the ETF, depending on its structure. For example, if you own 100 shares of an ETF and the ETF pays $1 per share in annual dividends, you'd receive $100 in dividend income. Types of ETFs that pay dividends. Equity ETFs. These ETFs hold dividend-paying stocks. For example, a high-dividend ETF might focus on companies with a strong history of paying dividends, such as large-cap or blue-chip companies. Bond ETFs. These pay interest income from the bonds they hold, often referred to as dividends when distributed to shareholders. REIT ETFs, real estate investment trusts. These often have high dividend payouts because REITs are required to distribute most of their income to investors. Example of ETF dividends. Let's say you invest $1,000 in a dividend-focused ETF with an annual yield of 4%. Over the year, the ETF generates $40 in dividend income. If the ETF distributes dividends quarterly, you'd receive $10 every 3 months. The amount of dividend income you earn depends on the dividend yield of the ETF, the number of shares you own. How are ETF dividends taxed? ETF dividends can be taxed differently depending on where you live and the type of dividend. Qualified dividends. These are taxed at a lower rate, often the same as long-term capital gains, if you meet specific holding period requirements. Ordinary dividends. These are taxed as regular income, which may have a higher tax rate. Some ETFs, like bond ETFs, distribute interest income, which is typically taxed as ordinary income. Benefits of ETF dividends. Passive income. ETFs provide a simple way to earn a steady income from your investments, especially from dividend-focused or bond ETFs. Reinvestment opportunities. If dividends are reinvested, they can help grow your investment through compounding over time. Diverse income sources. By holding a variety of dividend-paying stocks or bonds, ETFs spread risk across multiple assets, making income streams more reliable. Considerations for ETF dividends. Fluctuating payments. Unlike fixed income from bonds, dividends from stocks and ETFs can fluctuate based on company performance. Tax implications. Dividend payouts are often taxable, even if you reinvest them. Management fees. While ETFs have lower fees than mutual funds, those fees can slightly reduce your net dividend income. ETF dividends are an excellent way to generate steady income while benefiting from diversification and professional fund management. Whether you're building wealth or looking for income, ETFs make dividend investing simple and accessible.